Hello, everyone. Today's episode of Market Makers features the veteran investor, Mr. Nilesh Shah. Now, he is the group president and the managing director of Kotak Mutual Fund. And with more than 3 decades of experience in the capital markets, he has managed funds across asset classes, including equities and fixed income. Sir, thank you so much for joining us and welcome to the show.
Thank you, Asta, for having me over here.
All right, so we'll be quickly picking up the first question here. So, what is your outlook on the current market and the economic conditions, and how do these factors influence your investment decisions?
So, as an investor, I have always believed in playing a test match. Time in the market is more important than timing the market. And I'm truly fortunate to born in an era where India moved from about $300 billion economy when I started my career to about $3.7 trillion, a growth of about 12 times. And this is not the full stop this is just the beginning. We will grow another 10 times from current level over next couple of decades. And what else an investor can ask? India's growth will be better than rest of the peers. We were coaches to the global growth train. Now we are the engine. And unlike China, where country's growth does not convert into corporate earnings growth, we will see country and corporate both growing. The second G is governance. Our governance standards are better than probably most of the emerging market peers. There is respect for minority shareholders. And finally, there is green. We are living in an age of environmental challenge, to say the least. India is the lowest per capita carbon emitter in the world. So I'm truly fortunate to born in a market where I can take a longer term view, thanks to the 3G of growth, governance, and green.
Okay, so now, sir, quickly coming to the second question here, are there specific market trends or opportunities that you believe retail investors should pay attention to, specifically ahead of the general elections 2024?
So one, you need to be aware that there's no free lunch in economy or market. In equity market, you have to take PG along with Mandi, upside along with downside. Second, quality always pays. In my 3 decades of career, I have seen many kachra companies giving short-term return to investors. But invariably, in the long term, they end up in a disaster. Quality may be sometimes like a tortoise. It moves slowly, and kachra can run up as fast as a rabbit. But eventually, tortoise wins the race. And third, and the most important thing is governance, governance, governance. You enter into partnership when you make equity investments. When you view your equity investment as a partnership, half the stocks which are there in your portfolio, you would have never bought because you were partnering with someone who was not a worthy person. So please give your money only to a worthy promoter, person with him you want to go to long-term partnership. So be ready for volatility, always buy quality, and think equity as a partnership rather than short-term momentum trading.
Those were actually very insightful points. Now, moving on to the next question. In India, are we at the end of the rate cycle hike? And if yes, when do you think the RBI can start cutting the rates?
So we are truly blessed to have RBI as our custodian of monetary policy. Unlike many central banks of the world which manages inflation and growth dynamics, RBI manages inflation, growth, the government's borrowing program, financial sector stability. So they are, managing multiple objectives. Now, they have done a great job so far in managing inflation, growth, and rupee and fiscal position. My feeling is that having won over inflation, RBI is unlikely to cut interest rates in a hurry. They will wait for other central bankers of the world to see how they play their cards. If US interest rates are going to remain higher for longer, then RBI may have to follow them. My feeling is that RBI will play the cards of interest rate cuts probably in second half of 2024 after watching what US Fed and other central banker does and what Indian economy requires.
Okay. Now, moving on to the next question. The mutual fund industry, as we all know, is growing rapidly. What steps would lead to deeper penetration, especially in the B30, which is beyond top 30 cities market?
So, as of today, if you see, mutual fund industry is almost playing like this Hindi film song. कोई जब तुम्हारा हृदय तोड़ दे, तड़पता हुआ जब कोई छोड़ दे, तब तुम मेरे पास आना प्रिय, मेरा घर खुला है, खुला ही रहेगा तुम्हारे लिए. We allow investors, traders, individuals to lose money in cryptos, in Ponzi schemes, in speculative activity from equities to commodities to currencies. We allow them to lose money in gaming and on the other hand continue to deliver return to our mutual fund investors, hoping that subah ka bhula sham ko ghar laut aayega. But if we have to really popularize mutual fund, then again this Hindi song is more appropriate. ज्योत से ज्योत जगाते चलो, ज्ञान की गंगा बहाते चलो. I need to make people aware about financial financial investment. They need to be empowered through education to figure out that trading is bad, momentum is bad, investment is good. Trading is short term, investment is long term. There's no shortcut in life where you become richer overnight. Investment is like birbal ki khichdi, pakne mein time lagega. The second thing is level playing field. Today, different parts of financial system, be it bank deposits, insurance, NPS, mutual funds, they compete in a different level playing field. Disclosures are different, commissions are different, transparency is different. We need to create a level playing field between financial and non-financial investments, and within financial investment in terms of commission, disclosure, transparency, and so on and so forth. If we do this push and pull strategy, on one side, people are empowered through education. On other side, let the best person win. Combination of this push and pull will ensure that mutual funds today, which are reaching rich Indians, HNI Indians, urban Indians, also start playing equally important role in the rural India, in the middle class and poor India. At the end of the day, the most important need for financial security is at the bottom of pyramid. And mutual fund is one product where whether you invest 100 crore or 100 rupee, you get same return, same product, same services.
Very interesting. Okay. Now, another very interesting question here. Which pockets of the market are attractive for investing for the longer term?
So one, Astha, you are always dealing with the promoter. And you always want to back a promoter who has some sort of vision so that his company can, grow in right direction. Vision without execution is not useful. So you need someone who will work 24/7 to achieve his dream, to convert his dream into reality. And finally, you want to deal with a promoter who won't cheat you. Otherwise, company will make money, but money will go to promoter's house, not to our pocket. So promoter with good vision, execution, and governance is must. Now, there are few trends which we are seeing in our life cycle. One, globally, people want to reduce their dependence on China because of their design on Taiwan, because of their competition with US. We became back office to the world, providing IT and other services. Now it is time to become part of global supply chain and become manufacturer to the world. Companies which are engaged in serving local market as well as global market will be big beneficiary. We call it manufacturing theme from an investment point of view. The second trend which is happening in front of us is related to banking and financial services. More and more savings is moving to financial assets, and there is a fantastic performance in terms of non-performing loans today. A simple example is that about 6 months ago, we all heard about SVB crisis. That was America's 16th largest bank going into bankruptcy. There was a small Indian bank called Shamrao Vittal Cooperative Bank. They had to issue a press release saying that SVB means that American bank, not us. Can you ever imagine that the largest American bank was in trouble for our smallest Indian bank? That's the strength of our Indian banking system. I'm sure banks will do very well in the days to come. So manufacturing and banking, these are two themes which one can play for a longer term. But please remember to buy companies which are run by good promoters, having vision, execution, and governance.
All right, so that brings us to the final question for today's session, which is Indians' love for gold is very well known. So, what percentage of the portfolio should ideally be allocated to this, and what is the best avenue to invest in the yellow metal?
So, Astha, as of today, our view on gold is positive. We believe central banks around the world will be buying gold after seeing what happened to Russian FX reserves, which got frozen when they invaded Ukraine. Every central bank of the world is going to keep part of their reserves in gold, and that's going to pull gold prices higher. Second, today US interest rates are high, globally interest rates are high. Obviously, it makes sense to invest in interest-bearing deposits than gold. But who knows what happens in second half of 2024. Our expectation is that interest rates will start declining in second half of 24, and hence buying gold today makes sense. The only risk for Indian investor, there is 18% tax incidence on gold. What is worth 50,000 rupees worth in Dubai or Singapore market is worth 59,000 for the same quantity because of 18% tax incidence. This is encouraging gold smuggling. One day gold prices will come, gold tax incidence will come down, and that could result into straight correction into your market value. Subject to 18% tax incidence, which will reduce in future, I think gold is a buy. How should one own? The most beneficial is sovereign gold bond. Give you 2.25 to 2.5% coupon for 5 to 7 year lock-in. There is a secondary market liquidity for sovereign gold bonds. So anyone with a 5 to 7 year horizon should go towards sovereign gold bonds. Second, if you are not having that kind of horizon, then you can look at gold ETFs or gold fund of funds. And finally, if you are not interested, if you're not having demat account and you don't want to invest in, let's say, gold ETF or gold fund of fund, then you can look to buy physical gold. But Astha, we need to overcome two challenges. One, lot of women, go and do Vishy or a monthly investment with their roadside jeweler. It's their neighborhood jeweler. You invest on for 11 months and 12 months, the jeweler contributes and you buy some ornament. I mean, please refrain from this because we have seen n number of times how these jewelers run away with depositors' money. Second, we also have tradition of buying small quantity of gold on birthdays, on Akshay Tritiya, on Dhanteras. I mean, when you buy gold in smaller denomination, you pay premium of 25 to 40%. This is very, very high transaction cost. So instead of buying small quantity of gold, please do gold ETF or gold fund of fund. Instead of doing Vichy with roadside jeweler, please do it in gold ETF or gold fund of fund. That will give you far better opportunity and far lesser transaction cost.
Okay. Thank you so much, Mr. Nilesh. That was very, very insightful. And it was absolutely our pleasure to have you on the show. We do wish you a very, very happy Diwali.
Very happy Diwali to all the consumers of Upstox.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.